disappointing, and it's really due to the performance of the banks, and it's quite an unusual performance by the banks that we are seeing this year. Of course, May is the month that most of the big four banks pay dividends, and usually we see some strong support for those three banks that do pay their dividends in May ahead of going ex-dividend. So that's ANZ, NAB and Westpac. But that's nowhere to be seen this year. We are seeing instead a focus very much on valuations and selling for those big four banks going into that dividend season. If we have a look at the market today, it was a very slow day, and that's because Japan was on holidays in the region, and we'll also see the UK markets on holiday tonight. It was also data heavy. We saw ANZ job ads rising for the fourth consecutive season. Building approvals though down for the second month in a row, although up 20% on year. And of course we were watching the HSBC China PMI numbers coming in below expectations. We were expecting to see the numbers in line with the preliminary result of 48.3, instead coming in at 48.1. However, that didn't stop commodities from rising. In fact, around the region we did see copper prices reaching a 2-month high, and we also saw gold prices up by 0.5%, although the Shanghai Composite coming online after a 2-day holiday and seeing a loss there. So a quiet session, but it was really about the banks and the material space today. The materials having a positive impact, and unfortunately the banks having a negative one. I think if you have a look at the banks, most of the retail investors are still in the banks and probably holding them, and we're not probably seeing a lot of movement in terms of those mum and dad investors in the banks. Where we are seeing big movements is on the institutional side, and just as a result of the banks having performed so well throughout the last 3 or 4 years means that institutions, even though they've done absolutely nothing at all, the banks make up the majority of their portfolios simply because the share price has gone up and it's such a large portion of their portfolios. So given valuations where they are at the moment, we probably are seeing a bit of rebalancing because the banks are such a large part of most people's, most super funds and most institutions' portfolios, especially if they're focused in on Australia. So hard case to buy into the banks at the moment given the valuations out there, but for some fantastic results coming through. I mean, we only have to have a look at the result coming through from Westpac today ahead of market consensus, and yet the shares down by 1%. And we saw the same type of movement with ANZ last week, and NAB ahead of its result on Thursday, it's actually down 1%. I think NAB's going to be the interesting one out of the three reporting, the big four reporting in May, and that's because we know that Cameron Klein's planning to step down, and Andrew Thorburn will be the new CEO. And sometimes when we do see a new CEO, we do see clearing of the decks. So we're watching to see whether there are any signs of write-downs, especially to that UK business. Of course, the board would have to be involved in a decision like that, but NAB trying to clean up that UK portfolio, we're probably going to see an exit there in the next couple of years, and that's really the surprise card for NAB and its share price as well. But NAB, the bank's certainly a drag on the market at the moment, valuations at all-time highs, and that's because we've seen such a fantastic performance from the banks. It's not because the banks aren't looking good as a business, it's because the share prices have performed so well, because investors have been very supportive of the banks as cash rates have fallen in Australia over the last 3 or 4 years.
Do you think there would need to be, Julia, much more in regards falls in the bank share prices for them to start to surge again, as people look, maybe have been waiting for certain price levels for some of them to get back in or to add?
I think if you did see falls of around about 10% in the banks, that would be an attractive level for people to be getting back into the banks. But I think the problem here now is that most Australian investors are already overweight in the banks. So really for an improvement in terms of the Aussie share market, we're probably looking for an improvement in terms of China and the commodity space, but that's really nowhere to be seen. We saw the HSBC manufacturing numbers today once again coming in weaker than expected, and we know that iron ore prices, they're still struggling at about 106 US a tonne. So that's probably what we're watching. Having said that, you know, the Australian market has been very strong. We're still near those very 6-year highs. And if we have a look at the Australian market, this is the Australian market over the last 1 year. And you can see that we are still pushing those highs. It's not a negative story for the Australian market at all. And if you have a look at since the global financial crisis, although we're not hitting new highs, if you include the dividends that the Australian market pays, this is the ASX 200 accumulation index over the last 10 years. You can see that's the peak of the market in 2007, but including those dividends, we've already exceeded that point in 2007. So the Australian market's a little bit different from the US. The US doesn't pay such high dividends because we have different taxation policies in regards to dividends in the two countries. But of course, if we have a look at Australia and the very strong dividends which are paid by the blue chip companies, we've already exceeded that point in 2007.